Okay, good afternoon and welcome back everyone to our options education or advanced options education webinar session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're here to talk about a very topic that's very near and dear to my heart, because I've spent the last 13 years as an options strategist helping people better understand how to trade the markets. And I first started in currency trading. And for those of you that have traded currencies, you know that a lot of currency trading is heavily using technical analysis in trading. I use technical analysis very heavily in my decision-making process as far as to gauge a directional view. And I want to talk a little bit about the value of technical analysis and how you can use it to improve your options trading. And more importantly, show you some of the, I would say, pitfalls of of technical analysis, specifically where technical analysis is strong and where technical analysis is weak, because many times I see that investors will use an option strategy that doesn't quite suit the technical analysis that they're actually doing. So today what we want to do is we want to marry the two. We want to first talk a little bit about technical analysis, then we'll talk a little bit about option strategies, and then we'll combine them and show you why certain types of technical analysis techniques bode well for specific option strategies and others don't bode so well for certain option strategies. So we'll talk about both and make sure you understand how you can potentially utilize this in your own trading. So let's go ahead and get started here. Before I do, just a quick disclaimer. What we're going to discuss here today is purely for educational and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. Now, for those of you that are brand new to OptionsPlay, this is a tool that I will be using today, and you have access to free of charge, courtesy of the Montreal Exchange. It's available to you for both the platform, the weekly education like you're on right here right now, as well as on-demand video libraries and short put reports to help you better understand how to utilize options in your portfolio. So no matter what type of trader you are, whether you are an equity investor and you're trying to improve your equity investments, or you're speculating on specific option strategies, they're all designed to help you leverage options for your portfolio. It's completely free of charge. You can sign up using this link that's here on my screen, and I will post that into the chat window so that you guys can sign up and see and get access to it through that link. So let's go ahead and get started here. Now, what I'm going to start off with, like I said, is I'm going to start off by talking a little bit about technical analysis. I'll talk a little bit about my background and kind of how technical analysis is used in my specific area of trading and how I utilize it to help you guys better understand trading options. And then what we'll do is we will then go into option strategies so that you can see the different option strategies that I'm going to leverage. These are the high-level option strategies that you would typically use to trade a directional view. We think of technical analysis as a tool to give us a sense for where an asset, a stock, an ETF is likely headed, and we want to utilize that information to trade options with. So in order to do that, what we're going to do is we're going to go through the broad strokes or the major methodologies of technical analysis. And there are thousands and thousands and thousands of ways that you can use charts. However, I'm going to cover the broad-based ways that you can utilize the charts to gain a directional view. And first and foremost is always going to be price analysis, looking at just price alone, no indicators, using price to give you a sense for the directional view. That's the first, and a lot of people ask me, what type of indicator do I use, or what's my favorite indicator? My favorite indicator is price. Price is the only indicator that truly is what we would call leading. Everything else is really a lagging indicator. Then we'll talk a little bit about patterns, because patterns is really something that you can recognize off of just price alone, meaning no indicators. Chart patterns and price analysis is the fundamentals of technical analysis. And then you can get into indicators that are designed to help you confirm your directional view that you get from price and from patterns. And that's really where we get into overlay strategies. Many of you are familiar with moving averages or Bollinger Bands. That's an example of an indicator that overlays with the chart. Then we'll take a look at momentum indicators, which is something that many of you use in your trading, such as MACD or stochastics or RSI. And we'll talk a little bit about that, and specifically regarding the limitations of some of the momentum indicators, so that you understand that if you're trading options with these momentum indicators, that you use the right option strategy for the momentum indicator that you're using. And then lastly, we'll try to do some real examples using OptionsPlay. And at the end, we'll do a bit of Q&A. So let's go ahead and get started here. Now, the question that I want you guys to be able to answer and walk away from after today's session is really, how can I use technical analysis to enhance my views on the overall market and improve my options trading? That's the goal of what I want to accomplish here with you today. So let's go ahead and do that. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. Now, like I said, I started my career 13 years ago at a company called Forex.com. And if anyone's ever traded currencies or Forex, you're probably familiar with that company. Or some of you may be more familiar with Oanda in Canada, which is a Toronto-based company for currency trading. And in currencies, we spent a lot of time looking at charts because currencies aren't influenced by fundamentals the same way. There are certain fundamental factors that affect currencies over the long term, but most Forex traders tend to be very short term, and you rely heavily on charts. And through that process, I have worked with thousands and thousands of retail and institutional traders, looking at their strategy, helping them understand what's currently going on with the market. So I have seen, I would probably say, just about every single possible charting setup you could possibly imagine, every single possible charting package, every indicator. I've seen people with very few indicators. I've seen people with hundreds of indicators on their charts. And through that process, I've really learned to understand, what are the different ways to analyze a chart. I've looked at all different types of strategies just because I've come into contact with them from other traders. And I've learned a lot from that, and I'm here to help you whittle down that information into something that you can actually use, and then hopefully help you apply it to your options trading. Now, first, I want to start off by talking a little bit about what is the value of technical analysis. Now, before I do, just if everyone can please bring up your chat window, which is at the bottom of your screen, and please type yes if you use technical analysis in your trading. And please type no if you do not use any technical analysis in your trading. Technical analysis being charts, for those of you that are not familiar with it. Okay, so I see a lot of yeses. I see quite a few no's sprinkled in there as well. I'm curious as to, for those of you that don't use technical analysis, is it purely based on fundamentals? Is it based on news? You can type them into the chat window for those of you that answered no as to what you actually use to determine the direction of a stock. Do you use the news? Do you use fundamentals? I'm curious as to what people say. I see a couple of people saying news, a couple of people saying fundamentals, price and volume. So just so price and volume fall under technical analysis. I see a lot of fundamentals, and a lot of people prefer fundamentals. Now, I will say, I'm a very fundamental trader, but technical analysis is used for timing, because the thing about fundamentals is you can say that a stock is undervalued, right? It could be undervalued for months on end, or maybe perhaps even years. Especially for those of you that are fundamental traders, you must understand that a stock can be either overvalued or undervalued for a substantial amount of time. So the question is, if you're going to buy a stock that's undervalued, when do you buy it? Do you just buy it the second that you happen to be doing that research, or do you buy it when the timing is correct? And that's really where the value of technical analysis comes into play, even though you are a fundamental or even a news-driven trader, is that you can have a view, but you want to make sure that you time that view correctly. And that's really where technical analysis comes into play. So the value of technical analysis is a tool in your toolbox to help you forecast what is likely going to happen in the future based on what has happened in the past. And the key word here is what is likely going to happen, not what is going to happen. No one has a crystal ball, but we can use statistics and probability to give us a sense for when something has happened in the past, what percentage of the time did it go higher? What percentage of the time did it go lower? And we'll use that probability edge to inform our decisions. And that's what technical traders do. So again, for all of you that answered no, this is something that you might want to consider just as a tool in your toolbox to help you time your trades. Because as you can see here, in a stock that rallied from, let's say in this particular case, from $160 to $190, was there a better point to get in? If you bought it here, you would have a different performance than if you bought it here. If you bought it here, you would have a different performance than if you bought it there. So it's really about making sure that you time your trades correctly. Even though your trade may be purely based on a fundamental basis of a stock or an ETF or a market, What you still want to do is that you want to time your trade. So if you're bearish on a trade, where do you ideally want to time it? You can time it using technical analysis so that you try to short sell a stock near its peak. And when you're buying, you buy near the troughs. And that's exactly what technical analysis is designed to do. Now, the benefit of technical analysis is that you get three things that you do not get from a fundamental view. A fundamental view only tells you whether it's overvalued or undervalued. What it doesn't really tell you, or rather it does tell you two things rather. It tells you undervalued and overvalued, and potentially it can tell you how undervalued or how overvalued it is. So what you get is a sense for magnitude and you get a sense for direction. But what fundamental analysis lacks is timing. What technical analysis adds to all of this is not only a sense for the directional view, but how far do I think that stock's going to go? And at what time do I think it's best to get into the trade and get out of the trade? Now, one of the limitations of fundamental analysis is the fact that fundamental analysis can only be used on equities. You can't really use fundamentals on other asset classes, and it's a discipline that's not easily translated from one asset class to another. So you might be a very good fundamental analyst in equities, but perhaps you are looking at let's say you're looking at a bank, or let's say you're looking at an energy company. It would be of great value to you to know where interest rates are headed if you're looking at the banking sector. It would be very valuable to you if you can see where crude prices are heading if you're looking in the energy sector. Now, this is where your limitations of your fundamental analysis in banking and energy cannot translate into interpreting where interest rates are going to go and where crude prices are going to go. However, technical analysis can be used across all asset classes. So the same analysis or the same skill set that I'm using to determine that I think banks are going to go higher, I can use the same analysis to say, do I think interest rates are also going to go higher? Or do I think oil prices are going to go higher or lower? Because that is another factor that you need to consider in this investment day and age, is not only looking at the asset class that you're looking at, but what other factors affect that asset class and have a fundamental view or more of a technical view or directional view that line up with your fundamental view. So I hope that this gives you a better understanding as to why I use technical analysis so heavily, and it allows me to analyze so many different asset classes and have a view on so many different things, because again, when you're looking at the banking sector, you can't just look at the bank's balance sheet and fundamentals. You have to look at interest rates. You have to look at how other factors that affect the overall market. Perhaps you want to look at where's the market trading? What direction do you have a view for the market? What directional view do you have for the sector? And again, this is really where technical analysis shines, and I find fundamental analysis tends to have some limitations from that front. Now, technical analysis by far, no, it's not perfect. There are certain limitations as well, but number one, the key thing is that it provides me with what I consider an objective view on price, meaning a price doesn't lie. There's no lying in terms of where the price is. The price is either higher or it's lower. It's an objective view as far as where the stock currently is trading. And again, from my perspective, one of the best uses of technical analysis is that anything with a price, I can use this type of analysis for. So if I have a directional view on banking sector, I can take that directional view and see if the interest rate sector or if interest rates line up with that particular view. But the third part that I think is very interesting is the fact that no matter all of us here on this webinar, there are hundreds of us here. We all have different schedules. We all trade on different time frames. Guess what? If you're a fundamental analyst, you can only trade on pretty relatively long time frames, because if you identify a stock as undervalued, it's not going to become fully valued or correctly valued tomorrow. It's something that typically takes months, sometimes years, and there's no indication as far as when that's going to happen. So when you're a fundamental analyst, you have to trade on the time frame that matches your analysis. But when you're a technical trader, you can apply your analysis to a 1-day chart, a 1-month chart, a 1-year chart, a 1-minute chart. Whatever time frame you want to trade on, you can use the appropriate time frame charts for it. And that is where the flexibility of trading comes from, especially if you're trading options. Some of us like to trade weekly options, and we're better off using hourly charts. Some of us like to trade monthly options, and then we were better off using daily charts. And some of us like to trade long-term and 1-year, 2-year options, you might look at weekly charts. So you can quickly adjust your charts for the time frame that you're trading. So regardless of how often or how likely you want or how often you like to trade, you can adjust your charts for your time frame. Unfortunately, for other forms of analysis, you can't do that. So if you're the type of person that fundamentally looks at oil rigs and inventory of energy, of crude prices, then guess what? That type of fundamental analysis is only useful for one specific time frame that's suitable for that. You can't adjust your trading unless you adjust your strategy. And technical analysis is extremely flexible on that. So now that I've talked a lot about the benefits of technical analysis, let's talk a little bit about some of the limitations. So first of all, whenever we talk about a technical strategy where based on certain types of indicators you buy, certain types of indicators you sell, one of the things to really remember, and this is, I think, true for any type of strategy. I don't think there's any strategy that doesn't fall into this category, but that strategies only work in certain environments. So for example, if you are a trend following strategy or a counter trend trader, they only work in specific market environment. It's important to know when they're going to work. And this way, this allows you to make sure that you are aligned with your type of trading. And more importantly, what it allows you to do is afterwards, after a trade, sometimes trades don't work out. You want to be able to go back and review that trade and say, was this the right environment for my type of strategy? Because if you understand your strategy, you'll be able to go back and say, was this the right environment? And I noticed a few of you said that you follow newsletters. And my only concern with following newsletters is that if a trade doesn't work out, you don't really know necessarily why or whether or not it should have worked out. And it's hard for you to go back and audit that, which is why I always encourage users to seek out their own strategies, because when you seek out your own strategies, you're able to go back to a winning or losing trade and say, did that work out just because of pure luck, or did that work out because my strategy worked correctly? And the reason I say this is because many times I find that investors who don't really understand their strategy, the second they have 4 or 5 losing trades in a row, they jump ship because they lose confidence in that strategy. And they lose confidence because they have no way of going back and auditing the strategy and saying, you know, does my strategy need to be changed? Does it need to be modified for the current market environment? If you don't understand your strategy and you're just following someone else, you're always going to have that time period where you have a few losing trades and you're going to lose confidence in that strategy. You're going to jump to the next newsletter and the next newsletter and next newsletter. If any of you that have followed newsletters, you probably have found yourself in a similar situation where a newsletter works for a while and then it stops working, or it stops working for a short period of time and you lose confidence and you try to go to the next newsletter. And unfortunately, that's a vicious cycle that's just going to continue repeating itself unless you understand the strategy and you can go back and audit it. So I've spoken a lot about technical analysis here. So I think I've made myself clear as far as why I use technical analysis heavily in my trading. And I hope that this inspires some of you that don't use technical analysis to consider taking a look at it just as purely from a timing tool perspective. So for those of you that use news and fundamentals, consider using this as just a way to help you enter your trades at the most optimal time and exit your trades at the most optimal time, and maybe get a few percentage points out of your trade rather than just relying on fundamentals alone. But when it comes to options trading, when it comes to trading the strategy, and this is the fundamental difference, right? Because there are a lot of people that would consider themselves technical analysts out there. But the thing that I find somewhat ironic is that many of us that consider ourselves technical analysts, we spend so much time and effort and money and resources on our charts, but our charts is actually not what makes us any money, because you got to be the best chartist in the world, but you don't make money from reading charts. You make money from the trades that you make off of those charts. So that's why it's so important that we spend the time to learn, are we trading the optimal strategy for the chart that we're looking at? So what I'm going to do here is I'm going to break it down into 2 primary categories. And what I mean by that is that I have one category on the left and one category on the right. On the left-hand side, I have what I call strategies that are suitable for when you have a clear directional view. So you believe that the stock is either going to go higher or you think it's going to go lower, but you don't have a clear sense for magnitude. So many times you're going to find yourself in a position where you're going to say, I think the stock's going to go higher, and I know exactly how much higher it's going to go. And there's going to be other times you're going to say, I think the stock's going to go higher, but I'm not exactly sure whether it's going to go 5% higher, 10% higher, 15% higher, maybe because there's no price history, maybe there's no real way to understand. You just know that it's going to go higher, but you don't know how far. Now, what you're going to find is that there are different option strategies suitable for this type of strategy, for this type of outlook. And then there are other times where you're going to say, I have a clear sense for direction and I have a very clear sense for magnitude. So I think the stock's going to go higher, and I think it's going to go higher by 10%. You know, those are the two possibilities of where you'd fall under when you're doing some type of analysis. And there are certain option strategies that are suitable for each one. So when you have a clear direction, but you're not exactly sure as far as how far it's going to go, but you're pretty sure it's going to be a quick and fast move. So maybe this is a momentum stock. Maybe this, whoops. One second here. Maybe this is, I don't know what's going on, sorry. Maybe this is a momentum stock, and you know these types of stock can move a lot. Maybe it's a tech stock or a pharmaceutical stock that just broke out to a new all-time high, and you're thinking to yourself, this stock can move. I don't know how far it's gonna move, but I know it's gonna move. For those particular types of strategies, what you generally want to do is very simply buy a call or a put. A call if you're bullish, a put if you're bearish. These types of strategies have very good risk to reward because buying a call or a put means that you have limited risk with unlimited upside. So these are perfect for when you expect a big move in one direction or another. The downside to this strategy is that generally have lower probability of profit. So this is something that we will come back to and make sure that everyone understands. So especially if you're brand new to option strategies, I encourage you to go back in time, to go back to our beginners courses, our intermediate courses, where we cover the basics, the benefit of options trading, the buying and selling calls and puts. Those are the fundamentals of learning this type of strategy. I just want to make sure everyone can still hear me. If you can please type yes into the chat window if you can still hear me. I just want to make sure. Okay, perfect. So when you expect a big, fast, quick move, buying a call or a put is the suitable strategy. Now, when you expect a directional move, when you're not sure about the magnitude, and you think that it's going to be a relatively slow move, think about some of the banking stocks. They don't move a whole lot. So when they hit a support level, you might say to yourself, I don't think it's gonna go any lower, but I'm not sure how much higher it's gonna go, right? That's very common when a stock that's not a big mover hits a support level or resistance level, is that you say that I'm pretty sure that when a stock hits, let's say, let's just call this a resistance level, right? When it approaches that resistance level again, you can fairly confidently say that I don't think it's gonna go above that resistance level, but you can't really confidently say if it's going to maybe go down by 1% or 5% or 10%. You just know that it's unlikely going to move higher. And that's really when that type of environment comes out to play. What you want to do is you want to sell a credit spread. Again, for those of you that are unfamiliar with selling a credit spread, we have whole education events just on these strategies alone so that you can learn more about these strategies. Now, the benefit of a credit spread is that they generally have very high probability of profit. And I tend to find a lot of investors gravitate towards this strategy purely based on the high probability of profit. But I will say most investors that do that are missing the other half of the picture, which means that selling credit spreads have very poor risk to reward. So yes, you win all the time, but you win small. And then when you lose big. Right? One's not better than the other, but it's just important to understand that probability and risk reward are counterbalanced. You can choose one, but when you choose one, what you get is you're losing the other half. So it's important to understand that. Now, on the other half of the equation, there are certain times where you might have a stock that maybe breaks out from a range, and you know for a fact as far as where that stock might go. So maybe you might say, okay, this stock is starting to break out and I think it's going to break out and reach this prior high. So you have a directional view and you have a pretty good sense for how far that that stock is going to move. So in this particular case, when you expect a directional move with a clear target price, the best strategy to actually use is buying a debit spread. Again, for those of you that are new to debit spreads or new to options trading, we have whole courses or whole education events dedicated to just these three strategies alone: buying calls and puts, selling credit spreads, and buying debit spreads. So if you want to learn more, you can go back and review that after we finish here today. These strategies have much better risk reward, but they also have lower probability of profit. The difference here is that the risk to reward here is better than just buying a call or put. So those are the three strategies we're going to discuss here today in the context of all the different technical analysis that we can do, okay? So before I move on, does everyone understand these three strategies? Buying a call or put, selling a credit spread, and buying a debit spread? Please type 1 into the chat window if you understand it. Please type 2 if you're not familiar with these strategies. I just want to get a sense for the audience here in the room. Okay, I see a lot of 1s. I also see a handful of 2s. So again, for those of you that are unfamiliar with debit spreads, unfamiliar with credit spreads, before we finish here today, I will make sure that I send you guys the link to give you the courses so that you can review debit spreads and credit spreads on your own time. Okay, so let's go ahead and get started. So first, we're going to talk about chart analysis. This is where no indicators are, there's no indicators. You're just looking at price alone. This is by far, this should be your first and foremost analysis that you do whenever you look at a chart, is looking at price action. And what price action tells you is where there are naturally buyers of a stock and where there are naturally sellers of a stock. And many times these become apparent through what we call support and resistance lines, because support and resistance lines are telling us this is where buyers are stepping in, this is where sellers are stepping in, or at least that where there are no more buyers. And whenever you have multiple points that you can draw a line across, that gives you a good reference point as to where the market is willing to buy this particular stock and where the market is willing to, or is looking to sell that particular stock. So whenever we look at support and resistance lines, there are generally 2 ways that use support and resistance lines. In this particular case, this is a stock that's ranging between $40 and $48 or so. And the most recent price action was that it bounced lower off of a support, off of a resistance level here around 48. And there's 2 ways that you can look at this. You can either say 48 is where sellers are, so at this point I'm no longer bullish, or you can say 40, every single time it's hit 48, the stock has fallen all the way down to 40. So you can say, well, I think the stock is going to go down to 40. Those are the 2 possible ways you can look at this. As far as which way you lean towards, perhaps that's where you lean a little bit more on your fundamental side. Maybe that's where you lean a little bit more towards looking at the news, right? Because if you're more bearish, then you might target this lower target. If you're not as bearish, then you're simply just saying, well, 48 is a ceiling. I don't think it's going to go higher than that, but I also am not sure that it's going to go all the way down to 40. So depending on what your views are, you can trade the strategy that closely matches your views. So if you are in the camp that you believe that this stock is now headed down to 40, that is a clear directional view with a clear sense for magnitude. So what we discussed before is that when you have a clear direction and a clear magnitude, what you do is you generally want to buy a debit spread. So what I would do is I would maybe buy a $47 put and maybe sell a $40 put against that. And what that gives me is a very efficient way to play for this particular stock to go from 46 down to $40. If that happens, you'll probably get paid about 2 to 1 on your risk to reward ratio while risking only maybe 4 or 5% of the underlying stock price in order to do so. That's the most efficient way to deploy your capital when you have a directional view with a clear sense for magnitude. Now, on the flip side, if you think that this stock, if you think the stock is no longer bullish and you think it's going to maybe sit within this range for a little bit, maybe like what happened here, right? And it's not going to move very much, but you think it's just going to sit within a particular range, that's when you want to sell a credit spread. A credit spread allows you to profit as long as the stock stays within this particular range. If it moves lower, you'll be profitable. The only time you lose money is if the stock breaks above your resistance level. So selling credit spreads will allow you to take profit as long as the stock stays somewhere in this particular range. That's the whole goal of a credit spread. Now, if the stock goes lower, you will also make money. You just don't make any more money. On a debit spread, you make more money the further the lower it goes, okay? Does that make sense, everyone? Please type 3 into the chat window if this makes sense to you, that how, when you're looking at a price action of a stock and you're saying, well, I either think the stock's going to make a big move to the downside, I'll buy a debit spread, or I think it's just going to stay around where it is and I think it's going to, then you're better off selling that credit spread, okay? And this pattern's going to repeat, right? So if you're not quite catching on just yet, we'll see more examples of this and you'll start to get understand it a little bit more. The second one I want to take a look at is the same type of example, but we're looking at it in a different way, right? So we have a stock here where it had a resistance level, it reached that resistance level, bounced higher, and now it broke out above that resistance level, okay? And this is another common price action analysis that you do, is when a stock trades within a range and it breaks outside of that range. So you might have a stock that trades within a range for a period of time, and then at some point, the stock breaks out above that range, or maybe even breaks below that range. It could go either way, right? Whichever way it goes, it gives you that directional view. If it breaks above, that's a bullish view. If it breaks below, that's your bearish view. Now, when you have a breakout like this, many times this could be breaking out to a new all-time high. And you're saying to yourself, well, since it's breaking out to an all-time high, I don't really know how far it can go. I don't have any price history to go off of, right? This, you might, for those of you that are fundamental analysts, you might say, well, I have a price target because, you know, I can look at what analysts are saying, or I can use discounted cash flow to project out how much I think this company is worth. But most of the time when you're trading an option, you have a very short-term view, right? You have to get the direction and magnitude correct between now and July or now and August. So you need to have a very concrete target price. So in those particular cases, when you don't, many times what you might want to do is simply just buy a call option. When you think it's going to be a quick and fast move, think about it. If this is like maybe a biotech stock that's, you know, there's some news coming out, or maybe this is a, you know, more of a technology stock that you think is having a new product launch and it's going to accelerate pretty quickly, that's when you want to buy a call. Now, if you are more neutral, right, maybe you think that now instead of this $87 being resistance, now you think 87 is support, but you've also seen many times where a stock will just trade above that range, right? It doesn't really go significantly higher. It just stays above this new $87 floor. If that's the case, then you're better off selling a credit spread, because a credit spread will profit as long as the stock stays within this particular range and as long as it doesn't fall back below that support level. So that's how you can utilize debit and credit spreads, or long calls and credit spreads, in order to trade your breakouts. Now, I will say that many times when you get a breakdown, so let's say this stock, you know, this stock actually broke down a little bit for just a couple of days, but then quickly reversed back. But if, let's say, this stock, instead of breaking down, actually started to move significantly lower, the difference between a breakdown and a breakout is that usually breakdowns, you can go further back in time and see what is a target price. So we generally tend to find that breakdowns have a clear target many times in a particular trade. So breakdowns, you can either buy a put option if you think it's going to be a quick and fast move, or you can buy a debit spread because you have previous price history that you can use to say, I think the stock's headed to 65 or 60 or whatever price that is that it prior found support at. That's how you can utilize options to do that. And I have a few examples here to show you using BMO that might be useful in helping you better understand the strategy in terms of how you can use technical analysis to gain a sense for a directional view and a magnitude. So if that makes sense, everyone, please type 4 into the chat window. Perfect. I see a lot of 4s. Next, what I'm going to do is I'm going to look at some chart patterns. Now, chart patterns is really same thing, price analysis, but what you do is you notice different patterns that form and utilizing these patterns. And for those of you that are interested in learning, it's really, I think it's really interesting to learn the market's psychology and the market sentiment that explains why some of these chart patterns resolve themselves in certain ways. So double tops and bottoms really refer to when there are multiple instances when the stock reaches a certain level and sells off. That means the market is telling you when it gets to those levels, you have a lot of investors that are looking to sell that stock that they own, or maybe short that stock that is out there. Now, the thing about double tops and bottoms, and this is one of the things that I think is many times misused by technical analysts, is many people will say, okay, there's a double top, let me go out there and short the stock. But the thing about a double top or a double bottom is that it gives you a clear sense for magnitude, direction, but what it doesn't tell you at all is magnitude. So be very clear about this, right? You know, when you get a double top, there's nothing that tells you that the stock's going to decline 5% or 10% or however far. It just tells you the stock's it's unlikely to go any higher. And those are two very different things, to say I'm bearish on a stock versus saying I'm not bullish on a stock. And there's a distinction that you have to make as an options trader between the two, because that's the difference between buying a put in this particular case or selling a credit spread. So remember, when you get a double top, that just simply means that you're no longer bullish on the stock. And the best strategy for that is selling a credit spread, not buying puts, certainly not shorting the stock. So I see a lot of traders when they'll say, oh, this stock has formed the double top, let me short it or let me buy a put. That, in my opinion, is a very suboptimal way of deploying your capital, because just because of the double top does not mean the stock's going to move 10% lower. It just means that it's unlikely to move any higher. Does that make sense, everyone? Please type 5 into the chat window if that distinction makes sense to you. Okay, perfect. I see a lot of 5s. Next, I want to cover head and shoulders. Now, head and shoulders, for those of you that are unfamiliar, is a pattern that looks like this, what we call a left shoulder, a head, and a right shoulder. And this type of pattern, when you see a stock have this type of pattern, that generally is a bearish formation, meaning this is, we call a bearish formation. It kind of creates this, what we call this topping formation, and then it's bearish. Now, one of the cool things about head and shoulders is that the way that it's designed is that it does provide you with a magnitude, because there's a neckline and you can measure how far the stock rallied to reach that neckline, and you can use that same projection to get a sense for how far it's going to decline. So when you're using a head and shoulders pattern, this is where you have a clear sense of direction, and you also have a clear sense for magnitude. So for those types of strategies, you're better off either buying a put if you think it's going to be a quick move, or buying a debit spread if you think it's going to be slightly more of a controlled move to the downside. But head and shoulders, one of the few patterns that does provide you with a clear sense for magnitude. Cup and handle reversal pattern. This is just another very commonly used reversal pattern. This gives you also clear sense for direction and clear sense for magnitude. So for those buying calls and buying debit spreads are suitable. And lastly, flags and pennants. Flags and pennants are usually what we call consolidation areas, right? So especially when you see stocks that go like this, they basically go straight higher. But what happens is stocks that go straight higher usually have a period of consolidation before they can continue moving higher. And that period of consolidation is what we call a flag, a pendant, and there's many different shapes that this can form in, but they're all generally meant to give you a sense for a stock that has rallied a significant amount of time and then moved sideways and now is ready to continue moving. So for those types of trades, you also have what we call a measured move. So you can first measure the size of the move going into the pendant or flag, and then you can take that same projection to see how far the stock can move after that consolidation period. So again, these types of strategies have what we call a clear sense for direction and also a clear sense for magnitude. So buying debit spreads, buying call options, those are the types of strategies that are suitable. So that's just a very quick review. But the point here to make is that when you're using these types of chart pattern strategies, make sure, or just ask yourself, does the chart pattern itself provide me with a clear sense for magnitude? Because if it doesn't, and there are some that do not, make sure that you're selling the right type of strategy, selling credit spreads rather than buying calls, buying debit spreads. So does that make sense, everyone? Please type 6 into the chat window if that makes sense to you. Perfect. Okay, I see a lot of 6s. Next, what I want to cover is a very, very, very commonly used indicator, which is moving averages. Moving averages is what we call a lagging indicator, or what we call an overlay indicator, meaning it's an indicator that we overlay the actual price chart itself. The moving average just takes the average of the previous certain number of days, whether it's a 20-day moving average, 50-day moving average, 200-day moving averages, are the commonly used moving averages. You would simply average the number of the prices over the last 20 days, 50 days, or 200 days, and you plot it on the chart. And this is the blue line here in this particular case, if I'm not mistaken, is a 50-day moving average for this particular stock. And generally speaking, what we tend to find is that we will generally say that when a stock is below its moving average, it's bearish. When it's above its moving average, it's bullish. So as you can see, this isolates specific trends. So many times people will use the crossovers. So when a stock goes below its moving average, they consider it bearish. When it goes above their moving average, they consider it's bullish. Now, this is really where, this is one of the indicators that I think is most commonly misused. And the reason I say this is because we think of a moving average crossover as bullish or bearish, but ask yourself, does it give me a clear sense of direction? The answer is yes. But does it give me a clear sense for magnitude? And what you quickly realize is that a moving average tells you nothing about magnitude. It only tells you that the trend has changed. It does not tell you whether the stock's going to go higher by 1%, 10%, 200%. And all of those are possible. That's the thing about moving averages. Many times I've seen so many times where, like in this particular example, where a stock goes below its moving average, doesn't move lower. It certainly does, but it comes right back up. And so what you get is, this particular crossover, which ended up in a much bigger move, is no different than this particular crossover that ended in a much smaller move. So the crossover itself provides no information as far as how far that stock is going to rally. So same thing here, when the stock breaks out above that moving average, when that actually happens, you have no idea whether this stock is going to move this far and then start moving back lower, or this far and start moving back lower, or this far and start moving back lower. You certainly have no idea as to whether it's going to take a few days, a few months, a few years for this stock to continue moving higher. And that's the challenge when you're trading options, is that because when you're options, you have to pick an expiration date, you have to pick a strike price. These are all things that you need to know. And moving averages, unfortunately, is not one of those indicators that tell you that. And that's a huge limitation. It's important to understand that when you're selecting a strategy, because unfortunately, I see too many investors when they see that, oh, the stock has crossed above its 200-day moving average. That's bullish. Let me go out there and buy a call option. And they just buy whatever call option that comes first. And they don't really think about, well, is this going to stock run 5%, 10%, 20%? Am I buying a call option that suits that type of move? Am I buying an expiration date that suits that? Those are questions that are important to ask before you choose an option strategy. So when you're when you get a moving average crossover, it only makes sense to buy a call or a put if you expect that the stock is going to make a big move in that direction. And many times, in order to figure that out, you need other forms of analysis. Perhaps you might use other forms of chart analysis. Perhaps you might want to use fundamental analysis, because that's really where other forms of analysis can come into play. But predominantly, when you don't have another form of analysis to inform you that, you're much better selling a credit spread when the stock breaks below its moving average, because a break below its moving average is very confident in saying that I am no longer bullish on the stock. And the only strategy that allows you to profit on that is by selling a credit spread. So when it crosses below a level, you sell a credit spread. When it crosses above a moving average, you sell a bull put spread. Bear put spread, bull call spread, bear put spread, bull call spread. And this is really how you can trade these types of strategies without getting whipsawed back and forth, is when you're selling strategies, you can actually sell and give yourself quite a bit of leeway in the directional move of a stock. So I just want to make sure everyone is clear as to the limitation of moving average. Please type 7 into the chat window if this makes sense to you. Perfect. Okay, great. Now let's take a look at Bollinger Bands. This is another adaptation of moving averages, because a Bollinger Band takes the moving average and then applies a standard deviation to it. And what you get are two bands that go above and below your moving average. So, whoops, I don't know why this keeps happening. In the middle line, that's your moving average. That is the actual moving average of the stock. And then what you have is you have these two bands above and below. And what that provides you with is a range as far as where the stock is going to likely trade within from a 2 standard deviation range. So when you're using a Bollinger Band, this is quite different than a moving average, because a Bollinger Band is used as what we call a retracement strategy, because when it hits the upper band, that's telling you that the stock is likely going to retrace itself back to the moving average. So what's interesting about a Bollinger Band is that this is one of the few strategies that involve a moving average that do give you not only a sense for direction, but also a clear sense for magnitude, because you can measure the move from the top of the band to back to the moving average. And every time it exceeds that band, you're basically expecting the stock to revisit the moving average. So you know where the moving average is, so you can use that to determine both the direction and the magnitude. And for those, you can use debit spreads. So this is a simpler, in my opinion, way of using moving averages that give you a clear sense of direction and magnitude. Okay, so Bollinger Bands, a very common strategy. but many times can be used with a clear directional view. Lastly, I want to talk about leading indicators. This is where many of you spend a lot of time, because this is probably where I get the most amount of questions. I would say moving average is probably first. Second question of indicators is what momentum indicator do I use? So for those of you that use any of these, please type in which indicators you prefer: MACD, RSI, stochastics, whichever one you prefer. Please type them into the chat window. And I'm seeing a lot of them: stochastics, RSI, MACD, slow stochastics. So I mean, those are the common ones, right? That are most people use. But the thing to remember is that they are all measuring the exact same thing. They're all measuring momentum. They're just slightly different mathematical calculations to calculate momentum. These are what we call oscillators, because oscillators are indicators that oscillate around a zero line. And they basically range from an upper band, a lower band, and they basically will oscillate from one extreme to another, right? So, and the extremes provide us with our buy and sell signals. Now, very popular tool, very popular indicator. And what we've been taught, or many of you have been taught, is that most of these indicators have what we call these extreme levels. And when the market exceeds those extreme levels, they become either buy or sell indicators. So if it exceeds that upper band and crosses below, that's your buy, that's your sell signal, and the opposite is your buy signal, right? So many of you that have responded that you use these types of technical indicators, you're very familiar with these buy and sell signals that these signals generate. However, one of the things that I find most commonly misused by this type of strategy, which is similar to the moving average part, which is when a stock generates these types of sells or buy signals, there's nothing in the indicator itself that gives you any sense for how big that reversal is going to be. The only thing it really tells you is that momentum is no longer moving any higher. That's what this sell signal really is. It's not a real sell signal. What it's telling you is that this stock is no longer headed in the direction that it was originally heading in, that it's now reversing. How far is it going to reverse? 1%, 5%, 10%? There's nothing in the reversal itself that actually tells you that. That's a huge limitation of these types of strategies. Yet, I see so many people that use these signals as a reason to buy or sell a specific stock. That's not a good use of their indicators. And there are empirical studies that show this, that if you simply just buy every single time you get these buy signals and sell every single time you get one of these sell signals, the performance of those strategies are actually pretty terrible, because that's not what they were meant for. They were just meant to tell you that momentum has shifted direction. It doesn't tell you how far it's going to go. So when you're thinking about these type of momentum indicators, it's important that you remember that when you get these buy signals, that just simply means that it's no longer going down. It doesn't mean that it's going up. It doesn't mean that it's going to go up by a lot. It certainly means that it's just no longer going down. So just like the moving average example, the best strategy to utilize with a momentum indicator is selling a credit spread. So when you get this type of sell signal, what you do is you sell a call credit spread that makes money as long as the stock doesn't go above that price. When the stock gets below, when you get that buy signal, you sell a put credit spread that makes money as long as the stock doesn't go below that level. And you can do this multiple times. Every single time you get this kind of extreme value, what you do is you buy and sell. And as long as the stock doesn't exceed those levels, you can make money. And that's a type of strategy that you should really be deploying, because in this particular case, even if the stock just moves a little bit lower, you make money on that credit spread. Even if it just moves a little bit higher, you make money. So look at how often I make money on this particular strategy. But if I bought or shorted the stock every time that happened, I would not necessarily have made money on this type of strategy. So that's why selling credit spreads is an extremely powerful strategy, but it has to be used in conjunction with the right indicators. And for those of you that like to use momentum indicators, a credit spread is the right strategy to use. So again, this is a strategy that I most commonly see misused. And I think you should, when you go back tonight and think about your own strategy, ask yourself, when I get a buy or sell signal, is there anything in my indicators that tell me how far the stock can move? Because if the answer to that question is no, great, that's okay. There are strategies suitable for that. If the answer is yes, that's also okay. There are different strategies suitable for that. And it's just important that you think about that before you deploy your capital, or else you might be deploying your capital very, very inefficiently. Okay, so with that, what I want to do is I want to jump over to OptionsPlay. I want to show you one example. I'm going to show you BMO because BMO recently spent quite a bit of time below the $75 level. And I'll give you a bigger chart here just so that you can see it and to make it a little easier to see. I'm going to draw a horizontal line here at 75. And what you'll see here for BMO is that for quite a few months, it couldn't manage to get above 75. But recently, it managed to break above that, actually broke below it, but then broke above it again. So we're now trading just above that 75 level. So the question is whether or not I think BMO is going to continue to rally higher here. Now, this is a combination of a few different things, right? This first looks at price. I'm looking at price predominantly as my decision to decide that I'm bullish here on BMO rather than bearish. Perhaps there are some indicators that also tell me that things are a little bit oversold. None of the indicators are particularly oversold or overbought, so I don't have a strong directional view. So this is an example of where I'm bullish on BMO, but I don't really have a clear direction. I don't have a clear magnitude as far as how far I think the stock's going to go. I simply identified 75 as support. That doesn't mean the stock's going to rally. That just means the stock's not going to go below 75. Now, there could be an alternative view to say, well, you know, banking stocks are starting to recover. Maybe you have more of a fundamental view that you think that these stocks are now going to rally. Maybe you think the overall market's going to rally and you think a stock like this is going to come along for the ride. You can use technical analysis to say, well, at the minimum, it's going to reach this relative high around 78. And then the next level that I have here is this gap at around $84, $85. So perhaps if you're bullish, that could be your target. So those are the two possible, I would say, views that you might have by looking at a chart like this. So what I want to do is I want to show you how you can use OptionsPlay to set that up and compare the two strategies. So by default, OptionsPlay is going to show you buying the stock, buying a call, and buying a call spread. Now, what I'm going to do is I'm going to modify this, and I'm going to sell a call spread against it. So I'm going to sell maybe a 74.68 or 74.70 call spread here. I'm sorry, a put spread here. All three strategies are bullish, but as far as which one's suitable for me, based on how far I think this stock can move. So, and just so we can compare everything apples to apples, what I'm going to select is I'm going to say I want to risk $1,000 on this trade. That means I can sell 3 contracts of the credit spread, I can buy 2 calls, or I can buy 2 debit spreads. Now, if you look at these 3 strategies, you can see they roughly all risk about the same amount of capital, a little over around $750, $800 or so. So I'm comparing strategies that all have roughly the same amount of risk. So what I'm going to do is I'm going to say, well, what happens if BMO just stays within this range between 75 and 78, you know, which is the range that it's been hovering for the past few weeks. Let's say between now and August, it just stays in this range around 70, let's just call it 77 or so. As you can see, if the stock stays where it is, the only strategy that's going to make money is the credit spread. So as long as the stock doesn't decline, my credit spread's going to make money, even if the stock doesn't move at all. So again, when you're doing your analysis, right, this is clearly a stock that has broken above a resistance level. But again, just the breakout itself doesn't necessarily tell you the stock's going to make a big move. So sometimes you could say to yourself, well, it broke out, I'm no longer bearish, you know, I don't think the markets are going to continue moving lower anymore, but I'm not confident that it's going to really rally. You're better off selling a credit spread because it's going to collect some profits here in this particular case, $435 in profits for your roughly $750 worth of risk when the stock just stays where it is. Versus if you bought a call or a call spread, you would lose $280 or $178. Obviously not what you want if you think the stock's going to move higher. You don't want to lose money, right? So if you think the stock's going to stay where it is, sell that credit spread. Now, if you're a bit more bullish, maybe you're looking at other indicators, maybe you're looking at the market, or maybe you're looking at interest rates and you're seeing, I think interest rates can break out higher. If that happens, banks are going to move up with that. So then you can say to yourself, well, what happens if it does reach that $83 or $88 level? The next resistance is around 88. So what happens if the stock rallies up to 88? Now, as you can see, yes, if you sold the credit spread, you would make money, but you're still only making $435. And this is my, I see a lot of people sell credit spreads simply because they like selling credit spreads without really realizing how much they're actually giving up when they have that strong directional view. Because for the same amount of risk, here, if the stock rallied up to 88, instead of just making $435, which would have still been a nice profit if you sold that credit spread, you could have been making $1,900 if you bought that call option. And many times I see credit spread sellers not realize how much potential they're really giving up. Because you're taking the same amount of risk, why would you not want to shoot for the higher potential trade? When you do have that strong directional view, you should buy that call, or you should at least buy the call spread, because here you're looking at $1,900 worth of profit versus $1,600 worth of profit. That certainly looks substantially better than the $435. You're talking 4 to 5 times the amount of profit than if you sold the credit spread. So don't just sell credit spreads because you like selling credit spreads, or don't just sell credit spreads because they have higher probability of profit. And I see too many traders do that, is that they'll say, well, this strategy has a 56% probability of profit. This only has 34. I'm going to trade the one of 56. Yes, you get a higher probability of profit, but look at what you're giving up. You're giving up more than $1,500 in profit in this particular instance when you believe BMO is going to rally. So choose your strategy based on your magnitude views, not based on any other things such as volatility, right? And I've seen too many times where people will just sell credit spreads because volatility is high without really understanding what they're giving up. And this tool is really designed from the ground up to not only help you understand where directionally a stock is headed. So we have the 1 month and 6 month trend, and you can see that trend started turning higher on March 26th. Right, well before the stock started to rally here on May 26th, the trend indicator turned from bearish to started to turn neutral and started to turn higher. So, you've had a very early warning system that things have started to trend a little higher, that they're no longer bearish. So this has been sideways for a long time, but it started to turn around in late May. And now that you've had the breakout above that resistance level, at the very least, what you could have done is you could have maybe sold a credit spread. And as things start to get maybe a little bit more bullish, or maybe the fundamentals start lining up a little better, then you start looking at buying calls and buying call spreads. This is all designed from the ground up to allow you to do this type of analysis side by side and see for yourself which strategy is best suited for me, or which strategy is best suited for the outlook that I have on the underlying stock. So I really hope that this was useful in helping you guys better understand as to, a little bit more about technical analysis, how they should be joined with your options trading, and more importantly, the tools that you have access to help you do this type of work. So before I wrap up, just a quick few tips for those of you that are interested in technical analysis. Number one, price is always the most important indicator. I get this question a lot. What's my favorite indicator? My favorite indicator is price. Price tells me everything that I need. Momentum indicators, moving averages, those are all there to confirm my directional view that I first get from price. If any of the indicators don't line up with my price, then I can say perhaps my directional view is incorrect, but I don't get my directional views from my indicators first. I always use price first. Second of all, indicators should, again, I already said this, indicators should only be used as confirmation. You should never be buying a stock just because an indicator fired off a buy signal. You should always first look at the stock itself, believe that you like the stock, believe that you like the price chart, then use an indicator to confirm your views. And I really am a big advocate, having worked with thousands of traders now at this point and seen just about every single chart setup you could possibly imagine under the sun, is to use what I call the KISS method, fewer indicators to avoid analysis paralysis. I've seen too many charts that have 30 different moving averages on it, 5 different momentum indicators. Guess what? They're all measuring the same thing. They're just using different time periods and slightly different methodologies, but they're all measuring the same thing. If you're going to use all these different time periods, the only thing you're going to do is confuse yourself. So don't use multiple momentum indicators. Just use one. Don't use multiple moving averages. Or if you use multiple moving averages, use the same ones day in and day out. Use the same ones every single day. Don't use the 20-day today and the 50-day the next day and the 200-day the day after. That's how you lead to inconsistent results. And make sure that you understand your strategy fundamentally. And this was one of the things I was talking about in the very beginning, is that if you don't understand your strategy, the second you have a few losing trades in a row, you're going to lose confidence and you're going to skip. And guess what? Every single strategy is going to always have some point in your trading history where you're going to have a string of losses. No matter how good your strategy is, you're always going to have a string of losses. If you don't understand your strategy, every time you come across those string of losses, you're going to jump ship and you're going to try to find a new strategy. You're never going to really settle in a strategy that you feel comfortable with because you don't understand it. So whenever you're trading a strategy, try to understand it. So if you learn from someone else, try to understand why that strategy works, when it doesn't work, so that you can audit yourself after a string of losses and understand, is it the strategy that didn't work, or is it that just environment was wrong? And then decide for yourself whether or not it's a strategy that you want to stick with. And lastly, it's really important to be consistent with the same strategy. Again, strategies don't work all the time. Sometimes you just have a string of losses. Only strategies that you understand are you going to be able to have the confidence to continue trading even though you have a string of losses. And the option strategies, make sure that you're selecting a strategy based on direction and magnitude. Magnitude is extremely important in selecting the right option strategy. And understand the relationship between risk and reward and probability. I see too many traders that simply optimize for one side of the equation. They only look at probability. They say, I only want to trade something with 80% probability. And they don't see the other half of the equation, which is the strategy with 80% probability has really terrible risk to reward ratio. If you understand it, then that's great. But I tend to find that most investors that just look for high probability are missing half the picture. So make sure you understand that relationship. And lastly, hopefully, I hope that this inspires you to really experiment with different strategies using OptionsPlay, because that's really the power of OptionsPlay. It really allows you to put different strategies side by side and see how big of a difference in terms of performance these strategies are. A lot of people will say, well, a credit spread is really not that different from a debit spread. And they forget the fact that look at how much potential you're giving up between the credit versus the debit spread. Here you're making $400, here you're making $1,600 for the same amount of risk. You're risking the same amount of money between these two strategies. But if you think the stock's gonna make a small move and you think it's just gonna stay around, guess what? Better sell the credit spread. But if you think the stock's gonna make a big move, then you're much better off buying that debit spread. And you really have to just put the two side by side, look at your chart and make a decision. Do I think the stock's going to make a big move, and should I shoot for that, making that $1,500? Or do I think the stock's going to make a small move and I'll be happy collecting $400 or $500 even though the stock didn't move at all? Depending on the type of technical analysis you do, make sure you understand what the technical analysis is actually telling you. Many, many indicators do not tell you magnitude, only tells you direction. So with that, thank you so much. I hope that you guys find this useful in helping you set up your trading day, set up your analysis, and maybe help you review, kind of go back to your charts and start from square one and ask yourself, what are my indicators actually telling me? What do they tell me? What don't they tell me? Many times what they don't tell you is actually the most important part in selecting your option strategy. So with that, thank you so much. I hope you guys have a great afternoon. With this, what I'll do is I'll open this up for a few minutes for Q&A. I know I went a little long today, but I do think that this is a very, very important topic, and I do want to make sure that I cover as much as possible here. So if you have any questions, please type them into the Q&A window. So I have a chat window and a Q&A window. If you don't mind, please type it into the Q&A window and I will answer questions out of that one. Let's see. Where is a good place to learn technical analysis? Great question. So a great place to learn is what I call stockcharts.com. They have a thing called Chart School. Here is the link. I'll send everyone the link here in the chat window. I think it's one of the best resources online to learn more about technical analysis. They cover everything that I've talked about here. Ed is saying, can you give us tips as to how to quickly identify support or resistance lines? I will say support and resistance lines are really easy to learn once you spend enough time looking at charts. It's really just a practice thing. Basically what you're looking for are peaks that happen to be around the same area. They don't have to be exactly the same, but I tend to find that, charts that have horizontal support and resistance are more useful, because horizontal support and resistance makes psychological sense, because people tend to have a psychological number in their head as far as where they like to buy a specific stock, where they like to sell a specific stock. And that usually doesn't change, right? So it's not like 1 month they're going to have 106 in their head, and the next month they're going to have 104, and the next month they're going to have 103. They tend to have the same price in their head, as far as investors go. So that's why horizontal support and resistance lines, in my opinion, are the most useful. Do you use fundamentals at all? I use fundamentals all the time. When I would never buy a stock without looking at the fundamentals. I certainly would never short a stock without looking at the fundamentals. Fundamentals are a big part of my trading, but to time that trade, I need to use technical analysis, because I can think that BMO is the worst stock in the world, but guess what? I'm not going to short it when the stock has really taken a 10% move to the downside. I want to short it when it has moved 10% to the upside, because I want to sell high, buy low, right? So you have to look at your chart to say, if I'm going to buy, I want to buy low, and then make sure that you optimize that move. Only technical analysis can tell you that. Azim is asking, this was very good. I'd like to know when to use different strategies and perhaps even more examples next time. So sure, I'm happy to do more examples next time. I love talking about technical analysis. Please join us next week for our live market trading session. I do a lot of live technical analysis during those sessions, so I hope that you're able to join us for that. Bruce is saying, unfortunately, my internet connection went unstable and disconnected 3 times. Yes, this will all be recorded. You guys can follow us on YouTube. All of our recordings are there. You can sign up using this link. I will send this link to everyone here in the chat window. You can subscribe to us on YouTube and click on the notification bell. That's going to give you a notification every single time we post a new video. You don't even have to wait for us to send it to you. You'll be able to be notified. So I highly recommend that you use that link I just sent to everyone in the chat window to subscribe to us on YouTube. Are cover calls included in the with small and slow directional move? Yes, I would say that. Cover calls are certainly a strategy for when you expect a small directional move. Can we get the slides? So when we send out the recording, we will send you the slides as well. Bob is asking, this or that newsletter suggestion may be the starting place for an idea. I get your comment about newsletter with technical analysis. So Bob, you're absolutely right. If you use newsletters simply for idea generation and then you do your own analysis on top of that, I completely agree with you. Unfortunately, I tend to find that most people that use newsletters follow them without really doing a lot of due diligence or analysis on their own. And that's what I want to warn investors about. If you just follow a newsletter without understanding their strategy and you're not doing your own due diligence on top of that, that's when you can tend to lead to those type of results. Does OptionsPlay show unusual options activity? We do not show unusual options activity because I don't believe that unusual options activity is useful information for most investors, because even a professional investor that has access to tools that most retail investors do not have access to in terms of interpreting a trade, even then you're looking at what I consider a wild shot in the dark in anticipating what that trader is looking to do. So if you see someone trades 10,000 contracts of BMO calls, number one, you don't know if it was an open or to close. Number two, you don't necessarily know if it was to buy or to sell. So many institutional investors have certain tools that we use to try to get a sense for whether it's bought or sold, if it's open or to close. But what it doesn't also tell you, even if I was able to identify that someone bought 10,000 calls on BMO, that doesn't mean that that person is necessarily bullish on BMO. How do you know that person doesn't have a stock position that he's offsetting or using options, or maybe he has a futures position that he's offsetting, or he's, you never know what the true rationale behind someone's trade is. And if you follow it blindly just on that information alone, you might be trading the exact opposite of what that trader intended, which is why, again, I don't like using unusual activity because there's just no way for you to tell what the true rationale behind a trade is. You're making a guess at best, and many times that guess is wrong because you don't know what the existing position someone has before they put on that big trade. What time frame should we use for options? So generally speaking, options trading, you want to use a daily time frame. That seems to be, in my opinion, the best time frame, because hourly charts too choppy with equities, weekly charts a little too long term. So I always use daily charts. Raymond, thank you so much. I really appreciate it. When will you use diagonal spreads? Diagonal spreads are useful when you have contango, meaning short-term options are really elevated in terms of implied volatility, and long-term options are really cheap in terms of implied volatility.